If you are a good account, you have a little bit more power than anybody else out there, because insurance people know that I got the right rate right now. I know I'm making 5 cents on every dollar. So my rate is the correct rate. So I want to write the good stuff so I can make that 5 cents. I don't want to write the bad stuff. That bad stuff's going to go from making 5 cents and losing 5 cents. Okay?
HOA Insights is brought to you by 5 companies that care about board members: Association Insights and Marketplace, Association Reserves, Community Financials, HOA Invest, and Kevin Davis Insurance Services. You'll find links to their websites and social media in the show notes.
Hi, I'm Robert Nordlund of Association Reserves.
And I'm Kevin Davis of Kevin Davis Insurance Services. And this is HOA Insights, where we promote common sense
for common areas. Welcome to episode number 92, where we're again speaking with insurance expert and regular co-host Kevin Davis. And in warming up for this meeting, I'm reminded he puts a smile on my face. And we're going to talk today about what to expect in 2025 with respect to insurance. A little bit of a sobering conversation, but an amazingly informative conversation. We want your association to thrive. So we want you to be well informed about what insurance issues and costs you're likely to face at your association in 2025. We don't want anyone in our podcast audience to be surprised by what's going on out there. Well, this is a follow-up to episode number 91, another one of our popular Board Hero episodes. It was a fun one, told by a board member who had a drug house in their nice suburban community that caused enough trouble in the neighborhood that it led to a bomb scare. And I'll leave you with that. It's a heck of a story. If you missed that episode or any other prior episodes, take a moment after today's program to listen from our podcast website, hoainsights.org, or watch on our YouTube channel. Better yet, subscribe from any of the major podcast platforms so you don't miss any future episodes. Those of you watching on YouTube TV can see, if I hold it up, my HOA Insights mug with a cartoon on it. It's my favorite. I got that from our merch store, which you can browse through from our hoainsights.org website or the link in our show notes. You'll find we have some great free stuff like the mug I showed, the board member Zoom backgrounds. And so go to the merch store, download a free Zoom background for yourself, find the mug you'd like, and if you're the 10th person to email me at podcast@reservestudy.com with your name, shipping address, mug choice, and mentioning episode 92 mug giveaway, I'll ship that mug to you free of charge. We enjoy hearing from you, responding to the issues you're facing at your association. So if you have a hot topic, a crazy story, or a question you'd like us to address, you can contact us at 805-203-3130 or email us at podcast@reservestudy.com. Some of those questions led to today's topic, what to expect in 2025 with respect to insurance. Insurance was a big deal these last 2 years. So fortunately, we have the right guy here to help answer that question. So, Kevin, tell us more about what 2025 is going to bring with respect to insurance.
Okay. Let's start with a disclaimer in that every account should be viewed on its own merits. Okay. So whatever we talk about for the next 30 minutes, every account should be viewed on its own merits. That way, I'm going to speak in general terms. So we don't, a lot of phone calls say, Kevin, you said X, Y, Z. So every account's on its own merits.
You promised.
Yeah, exactly. However, this is the interesting thing. If you think about since COVID, coming out of COVID, the insurance companies looked at the numbers and realized that for every dollar they took in, they were paying out $1.05, $1.08, $1.06.
You can't stay in business doing that.
6 cents for every dollar.
Yeah, can't stay in business doing that.
And that's what they looked at. They looked at it because of, catastrophes that was going on out there. They look at the inflation that was happening out there. So many different things happening out there that they weren't making money. So now all of a sudden, a perfect example of that is, that I love is farmers insurance. Farmers insurance went from 106 to 105 and then went to 103. So last year they finished at 103.
Okay.
So that means for every dollar.
Explain that.
So for every dollar they took in, they paid $1.03.
Okay.
So they operated in the negative. And again, most insurance operated in the negative over the past couple of years. American Family, who writes a lot of community associations, they were at 114, okay, and 110. So after they realized those numbers, two things happened. They either A, pulled out of the market like farmers did, and American Family did. We don't write any more condominiums. Even though they have commercials, you see the commercials all the time, we're not in the community association in the marketplace. So they left, and then you had the other one that said, okay, we're going to stay in it, but we're going to raise the rate significantly. We're going to increase deductibles, up high, and we're going to lower the threshold, lower coverage.
Okay, I'm going to slow you down there. Raise rates.
Okay.
Raise
rates, increase deductibles, and limit coverage.
Yeah,
so
okay.
For the past 3 years.
Well, if I was losing money, I would do what I needed to do. And so the simple thing is, yes, raise the rates. If I'm at 105, I'm paying more than I'm bringing in. That's clearly not sustainable. You can't stay in business doing that. So you got to raise your rates at least 5% to get break even, or you can limit how much you're paying out, which is increasing the deductibles, or carve out a little tighter what you are and aren't insuring. Is that
perfect?
Okay.
Perfect.
Okay.
And as a plan B, say, I can't write this coverage anymore. I can't. It's too costly for me, and I'll never get the amount of rate that I need, so I'm out of this business. So that's what's happened over the past couple of years.
You just throw in the towel and say, I'm out.
Yep, I'm out.
Okay.
I'm done. So that's why you look at over the past couple of years, the demand was greater than the supply.
Because the supply had stepped out of the room.
Yep.
Okay.
Yes. So now all of a sudden you have limited supply. And so that supply is saying, okay, I'll be in this business, but it's going to cost you. It's all or you're going to participate in the loss. That means a $25,000 deductible if you have water damage. If that water overheats or the water spills over, you're going to participate in that loss. So now all of a sudden insurance companies are saying, we can't afford it. We got a great deal, and we're making changes right now. So for the past couple of years, the rates have been going up a lot, and people understand it and feeling it. You probably felt it yourself in your auto insurance.
Yep.
Yes. So now you look at numbers in 2025, and I love doing these talks because I have to do research myself. And I looked up farmers insurance. Because farmers insurance is big in California. They went from a 106, to 105 to 103 from 2021, 2022, and 2023. Right. 2024, they expect it to be at 95 cents. So that means for every dollar they take in, they only spend 95 cents.
I like that. I feel like that's what you want as a business. You want to make a profit, a sustainable profit, but not as a consumer. I don't want them to make a killing on me, but I want them to stay in business.
And 95 cents, 95, so 5 cents on the dollar is pretty acceptable. Right now, most of them are at 98 cents on the dollar. And again, it varies all across the board, but 98 cents. So this year has been somewhat profitable. One reason why it's been profitable, because the losses out there, the severe losses from the wind and the hurricanes and the fires, everything, have not been as great as they have been in the past.
Okay, explain that to me.
Okay, so in the past, so let's say that we have 24 weather-related climate disasters this year in 2024.
Okay.
24 of them, okay? Now, historically, you may have more, okay, but they didn't cost as much. So you average about $1 billion per storm. So that's about, $24 billion this year. But last year we spent more than $24 billion.
Kevin, just you throwing out words like billions, got me rubbing my forehead. Just
yes,
big deals. Okay,
but it is, and that's the issue there. And for example, we had two major hurricanes in the past several months. We had Milton in Florida, and Helene going up the coast. Now, what happened? Now, when we did a podcast, with Robert Nordlund a couple of months ago, and we were worried because those two storms came in, and we expected more storms to come in after that, because the hurricane season was still in effect then. But guess what? Milton wasn't as bad as we thought it would be, because it missed major areas, and Helene didn't damage the property that caused insurance a lot of money.
So it was more, it wasn't major metropolitan areas, densely populated, a lot of structures. It was more what I heard, flooding in Asheville,
yes.
kind of sparsely populated outlying areas.
Yes. And flooding is covered by the federal government, not by your regular insurance companies.
Interesting.
So the federal government took a big loss on that one, not insurance companies.
Interesting. So the type of catastrophe, and earlier you were throwing around, you're speaking so fast I had to slow you down. You're talking about cat this and like
Exactly.
so you live in the world of cats, catastrophes.
Yes. And what's interesting about cat losses this year, because they were lower, that the insurance companies still made money.
Okay, good.
So it wasn't significantly lower. It wasn't like, they still lost, $24 billion. The loss amount was in the billions, and it's still counting. Okay. And the year's not over yet. Okay. Even though this will be 2025 when they see this presentation, we have a couple of days left before the year. So what we're seeing now is because of the year, because of lack of cat losses, okay, now all of a sudden inflation has lowered and everything. So the cost to repair and replace the items, okay, has flattened out. All of a sudden in 2024, the insurance providers in the commercial insurance, the insurance that we're in, has made some money. Let's say they haven't lost money, okay? Because from the way insurance works is that they right now look on paper that 5% is meaningful, but they're still paying claims from this year. So still, it's like the claim from Milton and Elaine, they're still paying those claims. At the end of the year, it may go up a little bit, but still, for the first time, they have not. They should not lose money.
Good. Okay, so we're not, you and I, just talking to each other here, we're not really expecting that they're going to try to recoup all that money they lost in the last few years. They just want to get back to stability, making a sustainable profitability.
Exactly.
Okay.
Exactly. It's not a matter, because as far as they're concerned, if every dollar they put out, they for every dollar they take in, they lose 95 cents. They're okay with that, including cat losses. So they look at all the loss that they've seen, all the hurricanes, and say, well, guess what? We made 5. That means our rates are correct rates. Our rates are where they should be. If we are making 5%, with all the things happening out there right now, we feel good about what we're doing in the insurance industry.
As a consumer, I'm starting to feel good that, can I say the worst is over?
Can you say the worst is over? I would say we can feel comfortable with the coming year.
Okay,
let's put it that way. Okay. Now, what does that mean? Feeling comfortable. What that means is that I love to call this what we're talking about, the good, the bad, and the ugly. Okay. And I call it the good, the bad, and the ugly is for this reason. So if you're looking at insurance companies saying, guess what? We're making 95 cents at every dollar. I mean, we're paying 95 cents on every dollar. We're making 5 cents. That means we want to write more business now. Okay. We're ready because we know our rates at what they should be to make 95 cents. Now, there could be some disasters out there. There could be something happen, but guess what? There were disasters last year. We still made money. So we believe that we're at the right price. So now what's going to happen, what should happen is now on the good accounts, okay? The accounts that's
yes. Your asterisk.
Yes. The good accounts. And this is the most, this is the point that we're going to make today, right? Now, if you are a good account, you have a little bit more power than anybody else out there. Because insurance people know that I got the right rate right now. I know I'm making 5 cents on every dollar. So my rate is the correct rate. So I want to write the good stuff so I can make that 5 cents. I don't want to write the bad stuff. That bad stuff's going to go from making 5 cents and losing 5 cents. Okay? So that's what's happening right now. All the insurance companies are out there saying, okay, we got the perfect rate. So we want to use that rate to attract all the good accounts out there. So that's number one. So right now, if you are a good account, okay, you have leverage.
I'm going to follow up on that, but I got to tell you, my brain is spinning right now. Okay, we did a reserve study, 100-unit plan development, 100-unit HOA. No big deal. Should be easy peasy, asphalt, entry monument sign, no clubhouse, no tennis courts, no nothing. We bid it nice and low, should be a smooth, easy reserve study. We go there, we find out that the board member had misrepresented. He was new, no real fault of his own, but in this HOA, the association was responsible to maintain the exteriors of all the residences. And not only that, but the homes were all slightly different, and they were built over 5 years. And so basically, we had to inspect 100 homes and not just the asphalt and the entry monument sign. And so what did we do? We finished the reserve study. We said, thank you very much. And we put a note in the file, raise their rate 50% for next year.
Yeah.
And what you're talking about is the normal business reaction to getting slammed on an account.
Yeah. And you said something really great, because as a reserve study specialist, there's certain accounts you want to go after, the ones that are more profitable for you than the less, or it depends on what you are. You might want to do the complicated ones. You may want to do the easy ones, but you know what you want to do. And from an insurance point of view, right now, everybody's saying, I want give me the good accounts. We can do a better job on the good accounts. Now, that doesn't mean you're going to have people fighting over it yet. They're not fighting them because, again, 5 cents on the dollar can easily go to losing 5 cents on the dollar pretty quickly. All it takes is something, a catastrophe happening out there. So they're not going to go crazy, but the good accounts are. So let's talk about what a good account is.
Okay, we'll get to that. Okay. Let's see. What are we going to do? We're going to take a quick break for a message, but I want to talk about what's it take to be a good account. And you also talked about the catastrophes, but you mentioned a couple of Floridian type catastrophes. I want to get you talking about hailstorms, windstorms, wildfires, a lot of other things. It's not just
ice damming.
Lots of stuff. Okay, so hey, everyone, it's now time to take a quick break and hear from one of our generous sponsors, after which we'll be back with more Common Sense for Common Areas.
Tired of low returns on your HOA reserves? With HOA Invest technology available nationwide through SEC-registered Capital CS Group and Keystone Private Wealth, you can now grow your community's funds with competitive, tax-efficient returns while keeping them safe and accessible. Our accounts are held with Charles Schwab, and HOA Invest's API integrated technology gives you daily access to balances, holdings, transactions, Schwab statements, and a nationwide inventory of CDs and treasuries, all in one easy-to-use platform. Ready to grow your reserves? Get personalized strategies and a free investment policy review with HOA Invest, your trusted partner for securing your community's financial future.
And we're back. So, Kevin, we left, and I am aching to hear, how does an association know if they're a good account or how they become a good account?
If you're under 30 years of age, if your association less than 30 years, that automatically puts you in that position to be a good account. So number one, less than 30 years old. Number two, you have to be a well-managed, maintained association. That's where you come along with that reserve study. That reserve study is there. They paid attention to it. They have budgets. They have maintenance. That's number two. And number three, no losses or no significant losses. You could have a few losses, but nothing significant. So that is an account that you're looking at that every association you have that. Every insurance person out there right now wants that account. They want to write that account.
Okay, couple of questions. You talked about under 30 years. The flashing light in my brain is Champlain Tower South was 40 years old. So is this driven by Champlain Tower South, or is it just common knowledge in the insurance industry?
In the industry.
Okay.
Yeah. Because after 30 years, again, you, as a reserve specialist, everything, starts to break down, electrical, plumbing, everything.
Yeah, there's more. There's more that is old and inclined to fail. Okay, you can't do anything about the age, but you can do something about how well you maintain the place. So is it in good condition? Mother Nature, Father Time are undefeated, but you can put up a good fight. You can maintain the place and minimal losses. Is that related to maintaining the place well?
I would say the number one thing related to losses is maintenance of the association.
Okay.
Let's say that you have washing machine that have old rubber hoses in there. What happens to those rubber hoses? They break, and all of a sudden you flood, especially, and then you have a significant loss in there. whatever it is, and you associate the components, and again, you understand the components there. Whenever you don't maintain them correctly, what happens is you end up having a potential loss. And, from the roof, no matter what it is, you can have a potential loss in there for lack of maintenance. If you're under 30 years, okay, then those are kind of accounts that you have to be more aware that you have that control.
Okay.
That means when you're talking to your insurance agent, make sure he understands that you are a well-maintained association.
Press that button.
You have your research.
Press that button.
Yes. Talk to your insurance agent. Let them know that, wait a minute, are we going to get a discount this year? Now, do I think we had a point in time for discounts going to happen? No, I don't think so. Because at 5 cents on the dollar, you can easily go to 5 cents the other way. And you still have inflationary issues that they're concerned about. The repair and replace still costs a little bit more than they cost in the past. So I don't think so. But if you get an increase, they may say, listen, you'll give you a 3 to 5% inflationary increase. Okay. So on that. So I would say it goes to that. But I would say talk to your insurance agent about getting a discount. You never know. Because that's the kind of business that every insurance company wants. Looks like that.
Okay. So you talked about maintenance, and I'm going to push you into maybe a corner here, but you talked about washing machine hoses. Even inside a condo, we're not even talking a HOA or planned development. Inside a condo, that's private space.
Yes.
But you're talking about washing machine hoses that clearly water doesn't care about boundaries. If you get a break in a hose, it's going to create a mess. It will go through common area to get to the next home. So we're encouraging board members to be proactive here. Is that what I hear?
I tell you, it's a great point. Water heaters are the biggest problem. Okay. Those water heaters, people don't maintain them to the way they should maintain them. Okay. They leak. They cause problems. People are out of town. They're home. And again, you do have a problem because you're not allowed to enter somebody's unit and everything like that. But you have to, as boards, to save money on your insurance. Maintenance is the key. And let them know that things like water hoses and water heaters and those things are the ones that cause you problems, overflowing anything. Most of your problems you have in your community association is water damage. And that's why the deductibles are so high right now on water damage claims. You're seeing, 25 high deductibles. So if you're looking at your components, you want to make sure your components are up to date. And even though your reserve study may say it may last 5 years, look at it and see, will this last 5 years? Maybe we need to replace these hoses now. Maybe replace the water heater now. Maybe we need to do certain things that we haven't done in the past, because at the end of the day, deferred maintenance is the reason why, your association is paying a lot more money for insurance than anybody else. The ones that automatically is in that category of your rate's going to continue to go up higher and higher and higher is ones that have deferred maintenance issues. That's the problem ones.
Yeah, Kevin, you got my brain spinning again. We had a client, and we dealt with this nuance that one of the foundations in my business is there's a 3-part test for what should be included in a reserve study. And it starts with it needs to be a common area maintenance responsibility. This board of directors, it was a high-rise, wanted us to include washing machine hoses in the reserve study because they wanted to proactively replace them. And the project manager came to me and said, Robert, we can't do that because it's not common area. And I said, again, when water leaks, it goes through common area. So they are protecting common area by replacing the washing machine hoses. And I can see that same issue for, like you say, water heaters and other things, that there is a real reason to be proactive. And that's that combination between maintain the property and minimizing your losses. If you see a loss about to happen, if you see the hose spigot out by the pool where the pool service company sprays off the pool deck or something like that, and it's leaking, it's always been leaking, or the pool gate, it never quite closes quite right, fix those things. Do what you can. I have a feeling those are those leverage points that are going to push your association from the average who cares about it into the, and your word were good account or preferred account.
Yes. Yeah.
Nice.
And it's such a important thing what you're saying, because just the self-closing gate you should have on the pool. How often you see that one's not shut all the way, it's shut just a little bit, and that's what causes your liability claims.
Yeah.
All of a sudden you have a kid that drowned, that didn't belong in the area, and all of a sudden the association upset because somebody snuck in.
Yeah.
And you say that, well, but your self-closing gate is not self-closing. So all of a sudden, you have a huge multi-million-dollar lawsuit because if it was self-closing and it closed, it said we did everything we could do to control the loss. We had it. But if you didn't do it, now all of a sudden the loss is greater. And that, again, that's another part of some of these accounts where the rate's not going to go down because you still have situations out there where the payment amounts on these liability claims are still pretty high.
Yeah, if you have a waterfront association, whether it's a lake with a dock or oceanfront, there's still a liability possibility there. Okay, walk me through some other things. We talked about wind, hurricane, and flood type things in Florida and the Southeast. How is that different if you go to situations like ice storms, snow load, hailstorms, and even fire exposure, wildfire exposure? Is it the same things apply?
All right, it's interesting because what they do is put higher deductibles, okay, on things like ice damming claims, okay, hail, wind, and they also put a higher deductible, or they put a percentage deductible on them also, okay, meaning that you'll participate in that loss by about 2 or 3%. Okay, so what the insurance company has done over the past couple of years, again, they have not made changes in how they're going to handle the claim. They're saying, we recognize that community associations will have losses, and we know where the losses are coming from. So what we're going to do is have you participate in those losses as much as possible. If there's a fire, there's other avenues out here to handle the fire. We're not going to use our insurance to pick up this fire. If you have ice damming, if you have hail, what we're going to do is say, we're going to give you another product, another product to cover that up. But if you ask me to pick it up, it's like your earthquake policy. You have an earthquake policy. A lot of that earthquake policies in California is a percentage deductible. So I have a $100,000 claim, and if it's a 5% deductible, it's a $5,000 percentage. So I'm participating in the claim.
Okay.
So basically what's happening right now is the insurance companies, even though they recognize that they're making 5 cents on the dollar, they know they can lose 5 cents on the dollar. And so they are saying, you're going to participate in these losses and help us out, because if you do that, the likelihood of a loss will be slightly diminished, and you will think long and hard before you submit the claim or not. Because you may have that water damage claim from the washing machine hoses, and you go, wait a minute, if we submit that claim, our insurance rate's going to go up. I don't want that. So I will pay for it ourselves. We will take care of that ourselves, and then we will bill back the unit owner that caused the problems. So it's really tricky right now with insurance because, yes, they're making money. They're doing things a little smarter, but they're not changing the way the coverage is.
Okay. Now, I hear you with a couple of things. One is that you're talking about the difference between losing 5 cents on a dollar per year and getting back to a healthy place, which is maybe making 5 cents on the dollar per year. And one of the ways is playing with a deductible, which can shift it a couple of cents right there. And that helps the insurance company feel a little bit closer to where they're getting to a stable point. They can trim off from losing 5 cents to at least losing only 3 cents if they are potentially shifting that. What about if you have I'm thinking from 4th floor to 3rd floor, you have water damage between two things. And maybe you get to a decision point, it's going to cost $20,000 to fix that water damage. Do we do it internally and spend the $20,000, or do we notify the insurance company and they raise our rates by $50,000 per year?
Exactly.
Okay.
That's it. Yeah.
Interesting.
That's the worry right now. The worry and again, the association knows that. That's where you talk to your insurance agent, insurance producer, your broker, and say, listen, this is where we're at right now. What happens right now? Because there will come a point in time where when they start making 10 cents on the dollar or 12 cents on the dollar, where now all of a sudden two things happen. The deductibles will go back to being reasonable. Okay. The coverage will come back. Okay. Then premiums will drop, because it's all a matter of, am I getting enough money to pay the claims? And everything boils down to that. So if inflation is no longer a problem anymore, and we think we're making enough money for the cat losses out there, then guess what? We feel comfortable with the amount of money we're charging, to the point where, you know what, let's open that door up a little bit and say, okay, yes, a 30-year building I don't like, a 35-year building I don't like, but maybe I'll change it from, make it 32 years.
Yeah.
Okay. And then what happens, okay, 35 years. And then anything before, and that's what happens. And that's what happened in our industry and happened in any industry, is that they want to grow. If they're making 10 cents on the dollar, it's a healthy organization. Now they want to expand it. And if they start losing, they may go back to 95 to 98. They're still making money. And so it's a matter of, for us to know and understand that right now, is this a buyer's market or a seller's market?
Yeah.
It's kind of when you're buying a home. And historically, for the past 4 or 5 years, there's been more demand than supply. Supply is coming back in. When farmers and American family come back in, now obviously you have more supply. And that more supply, then all of a sudden you're going to have the rates will start getting lower and getting lower and getting lower.
Yeah, because as we know in our country, with the free market economy, if someone's making a lot of money on something, or even a reasonable amount of money on something, there's going to be other people saying, yeah, we want a piece of that.
Yeah, exactly. Yes. And what happens is it's interesting for insurance because this is normal. This is the way the insurance cycle works. It goes up and down. Now, this is the last time it went up was after 9/11. 9/11, buildings came down. We lost a lot of money on just the cars alone that was parked at the World Trade Center. And then you had 10 years after that, you had the fiscal crisis that we've had. The rates went up and down. Now, this is the most the rates have been up in a very long time. And I think the reason why, because we missed a couple of years of COVID. Once during that COVID area, all of a sudden people took their eye off the ball a little bit, and they started to see that for the past 4 or 5 years, we've been losing money. And then they start seeing why. And then inflation started coming. To repair in a place costs a lot more money than it did 5 years ago. And the value of your home is more than it was 5 years ago. So a lot of those increases are due not because of the greed of the insurance, it's that it costs a lot more money to repair, replace some of those components we talked about earlier.
It just fundamentally does. Inflation is real.
Yep.
Okay, but we heard that the Fed is going to anticipating lower interest rates. They're going to lower their magic rate. They are expecting to lower that a couple of times in 2025. That's good. And with more...
one thing about that, I'm glad you mentioned that, because for the first time, insurers have made a lot more money off of their interest rates. So they put that money in. So you're talking about the billions of dollars in losses that we have. Let's say that, they had $24 billion in loss. What they do, they take $24 billion out and they put it over there to fund claims. Okay. Now that's stuff they get interest off of that. So interest rate is at that high interest rate, they make money off that interest rate also, as opposed to zero interest rate, which has been for the past 10 years, however long it's been.
Well, that's exactly what associations are finding now. In the last few years, they were getting somewhere between 0 and 1% on the reserve interest, and now you can get 3 or 4%, and that's a nice swing that really helps the reserve funding. And I can see the insurance companies with their bigger piles of money that they have to be ready for the billions of dollars of losses. Yeah. Boy, it's got to be nice for them to be making 4% instead of 1%. Nice stuff.
And if I make a lot more than that.
Let's not go there. Let's trust that they have wise money managers making smart decisions. Well, Kevin, as always, it's great talking with you. Any closing thoughts to add at this time?
You know what? I would say this. Control what you can control. Certain things you have no control over. If you're over 30 years, you're over 30 years. But show your insurance provider that, guess what? Yes, we're over 30 years, but we don't have deferred maintenance problems. We're on top of what we're doing. We have a reserve study. We oversee it. We have a maintenance contract. We do the things so that we don't look at us as just because we're over 30 years that we're uninsurable, or we shouldn't have good rates. If you control what you can control, you'll be in a better position if you happen to be over 30 years. If you're under 30 years, then I would say be assertive, be aggressive, and say, guess what? I'd like to see if I can get a lower rate. And above all else, okay, make sure you understand that each account is underwritten on its own merits.
You're looping us back to where you started. I like that.
Exactly, because I know I'm getting a couple of emails saying, "Well, Kevin, you said yes." Each account there is underwritten in its own merits. So
yeah, well, I like having you on.
My closing thought there, Robert.
Got it. Okay. Well, I like having you on the account because to me, you make things so clear. And likewise, we hope you in the audience learn some HOA insights today from our discussion that helps you bring common sense to your common area. We look forward to having you join us for another great episode next week.
You've been listening to HOA Insights, common sense for common areas. If you like the show and want to support the work that we do, you can do so in a number of ways. The most important thing that you can do is engage in the conversation. Leave a question in the comments section on our YouTube videos. You can also email your questions or voice memos to podcast@reservestudy.com or leave us a voicemail at 805-203-3130. If you gain any insights from the show, please do us a huge favor by sharing the show with other board members that you know. You can also support us by supporting the brands that sponsor this program. Please remember that the views and opinions expressed in this program are those of the hosts and guests, with the goal of providing general education about the community association industry. You'll want to consult licensed professionals before making any important decisions. Finally, this podcast was expertly mixed and mastered by Stoke Video and Marketing. With Stoke on your team, you'll reach more customers with marketing expertise that inspires action. See the show notes to connect with Stoke.